Hi and welcome to today's show. I'm your host Rebecca Robertson at Accelerating Your Wealth, and today we're going to be talking about money in the context of investing and how much £100 a month could really be worth and what it's costing you to not invest. Hi and welcome to Accelerating Your Wealth with your host, myself, Rebecca Robertson. I'm an independent financial advisor and wealth coach. I'm the director of Evolution Financial Planning, who is also our sponsor for today's show. Don't forget to like, subscribe, share and review this episode. With your help, we'll reach more people who can benefit from the show. Quick one before we get back to it. If these conversations are landing for you, we've made something to help you go deeper. It's a short quiz. You answer a few questions and it tells you where to focus, then builds you a playlist of every relevant episode so you're not hunting through the whole back catalogue. Investing, divorce, business, there are 9 areas to land in. The link's below. Now, why is this important? I see this all the time with friends, with family members. They just don't think about investing. Now, the point is actually if anyone's ever worked and been in employment and not opted out of auto enrolment, they will be an investor because they're investing in via their pension. That little place slip that has that money going out saying pension contributions, that's a form of investing. It's just going into the type of wrapper that's called a pension. So you don't necessarily have to be thinking about investing of trying to figure out who, is it good to invest in Meta, or should I be investing in AI? Should I be investing in Bitcoin, or should I be buying gold? It's not about that. That is, I think, for me, a bit of a red flag and can send people off onto tangents. One example is that I had a client who had invested in Bitcoin. And I said to them, you need to be doing some of the basics and we need to focus in back on your pension. And she'd used her pension and her tax-free lump sum to get out of debt. She wasn't able to get back into a job. She went for a bit of a career bump and it meant that there was bills going out. She had a lot of debt and she had to use her pension. She was 57. And she had to use her pension. It wasn't a massive pension either. So she took some of the tax-free lump sum and cleared her debts, which is not really what we would advise people to do. But those in financial difficulty and her circumstances, there was no real option. She eventually did get another job and she's doing incredibly well. And she's got a great pension coming through from there. But because of that, they had to move out of the area and they wasn't renting. And I was always encouraging them to find a way to save, to put into their investments so that they could then buy a house. So when they were going into their 60s and late 70s, that they weren't then renting and relying on a landlord keeping a roof over their head. And she saved and they also invested into their, carried on paying into their pensions. And I managed the small pension where they had previously drawn from. And she and her partner, which was a female couple, had very joint finances. And when they were ready to buy, they wanted to then use their Bitcoin investments that they had grown separately. And unfortunately, they had tanked and they were doing so badly because they're so volatile. And what did she come back to? She came back to her pension, and the difference that she was able to take out about 5% of the pension, and that then meant that she could buy this renovation house that now means going into her early 60s, the landlord when they left recently had actually then put the rent up, and it's around the same amount, the mortgage, to what their rent would be. And it means now that over the next 12 years that mortgage will be paid off, and then they actually have a family home that they can stay in the long term into their later years, all because of her pension, not the Bitcoin. So I'm not saying don't do some of these other great things, that there might be sort of some shiny objects, but you've got to do the foundation and the basics first. So investing for me is not necessarily trying to figure out, like I said, should I be buying into Meta or Apple or Alphabet or whatever. Alphabet. owns Google. It's about, okay, what current structures have I got in place, and how can I find the right amount of money, or as much money as possible, just to pop it aside into a form of investment portfolio. It could be managed for you, or it could be with a platform that's cost effective, and they invest in lots and lots and lots and lots and lots of different companies, and you haven't really got to worry about all the rest. You want it as diverse as possible and not too much risk, that's within your risk appetite. And you can listen to other episodes around where I've talked about investing. This is about what you're actually losing out by not doing it. So the starting point, let's have a look at £100 a month. So I think for a lot of people, that might sound like an awful lot of money to find right now. But if you think about, if I had a takeaway once a week, that's £25 maybe for a family, sometimes more. That's how much you're talking. It might be adjusting your lifestyle to then invest in something different for your future. But why do that? Why do that now? So for some people, they're not wanting to give up the holiday, or they're not wanting to give up their takeaway because they want to live in the moment and live for now. Why put money aside? And it's about looking at your finances and saying, okay, this is much is for play. This is for much for now. This is for these shorter term goals, maybe over the next 6 to 12 months or longer, the next sort of 5 years. And then this proportion, and you can sort of allocate it as 10%, 20%, 30% of what's coming in each month needs to be for that future, because it may or may not happen. I get that. I know how people feel when it comes to if they've lost somebody, and that real feeling around, life's for living, tomorrow might not happen. But it's also important to look at that longer term and say, well, if it does happen, I need to not only be able to look after myself, but also it might be looking after my family, or it might be that I need to have additional care needs, or it might be that I need, have I got the right protection in place if I was ill or off sick? It's also about not thinking about yourself, it's thinking about your family and the greater picture, because we've had family members have to live with us because they haven't got the provisions in place to look after themselves, and that's no disrespect to them at all. They were more than welcome, and we loved having them, and that wasn't down to their own fault really either, but by not putting that amount of money aside, even if it is a small amount, can be a detriment to that longer term future. So £100 over 20 years. So if you think about doing that for 20 years, feels like such a long time. So I'm 45 as I'm talking now, so I'd be 65, and I plan to retire at 65, 67, roughly, depending on how I'm feeling at the time. But it feels like so way off. It just feels like such a long way. It's like, well, why am I worrying about 20 years time? But by doing these small things now, it can have a massive impact when I'm 65, when I actually probably don't want to work anymore. I don't want to be bringing that money in. And what I notice the biggest thing when people are looking to retire, I've got quite a few clients at the moment that are at that point of retirement, and they're quite anxious about the fact that their income's going to stop. And it's only once the new pension money starts coming in, and they know it's not going to, we're not taking too much, so it's not going to run out too soon. But there's real anguish around, is there enough? And unfortunately, if you have delayed this sort of 20-year, 30-year, 10-year window, then that £100 that you're putting in will need to double. So if I don't do this for the next 10 years, it's not £100 a month, it's £200 a month. If you delay it again, it's not £200 a month, it's £500 a month, etc. So you're basically then pushing a bigger problem down the road. And because of compound interest, which I'm going to come on to, that's then even more the case. If you're somebody that is not sure what to do with their finances, maybe you're working and you're not sure what to do with the bonuses you've got at work, or maybe you started a business and you've got profits and you're not sure what you should be doing to enable you to A, pay yourself more, or B, potentially retire earlier. Maybe you're somebody that's thinking about, do I overpay on the mortgage? You've received some inheritance. You've got lots of questions around your finances and what to do next. Then check out Evolution Financial Planning, who are regulated independent financial advisors and financial planners that can help you make some of those big decisions in life. So over 20 years, £100 a month would become 24,000. So what could that actually turn into? So depending on how you invest, but typically a long-term investment will be anywhere between 5 and 7%. That's relatively conservative depending on how you invest, but we keep it as that for now. So that would roughly grow, that 24,000 would grow between 40 and 55,000, depending on the returns. Now, the reason for that is because of the compound interest. So each year when you're earning a little bit of interest, that's added to your balance. So then the next year, it's not just the £100 that you've put in the last 12 months, it's the interest that you earned the previous year. So the more you put in and the more interest you get, the bigger the compound effect. So I recently have done quite a few reviews with clients, and the range of returns are all between 15 and 24% over the last 12 months. We've had a really good 12 months in terms of returns. And they're all ranged different kind of risk structures and volatility and exposure to certain markets, etc. But with that, obviously the bigger the balance, the more money. So one client had over £150,000 returns of monetary value because they have more money in the pot. And that's how people with more money make more money. When there's a recession and someone's having to sell their house really, really cheap, those people that have got some spare cash in the bank because they've been saving or investing and they've had good returns can then use some of that money to maybe buy another property or move house and upscale. Although I don't always advise that. It's often best to be more conservative when buying houses because of the amount of interest you're paying. So that compound interest every single year adds up over time. And when you break it down over the years, it can have that really good, massive impact. So it means that the more money you have invested, if you can increase that £100, then that obviously is much, much better. But you're taking, say, 24,000 and it could be worth 40 or 50,000 rather than it just sitting in cash. So if you put that money aside and it's in savings, which is more money that you need for emergency, those shorter term, then you'll get a really low interest rate. And we do have times where interest rates are, not too bad. It might be maybe 3 or 4%. But that's only right now. That's actually not over the long term. So investing is about putting the money away for that longer term objective. So cash often struggles to beat inflation over the long term. And by investing, although it does have volatility, it can go up, it can go down, it does tend to, over the long term, beat inflation. And so it means that if you don't invest, that actually with inflation, that 24,000, because you might only become, say, 25,000 with low interest rates over time, you've not beaten inflation. The value of that money, because it's been 20 years, if you think back to 20 years ago, how much things cost. Some things were more expensive because they were new, like broadband and internet, for example. They're much cheaper now. But if you think about products like bread and milk and butter, those kind of things, even just in the last 18 months, they've massively increased in price. So that 24,000 in terms of buying power doesn't have the same impact. So you then, when you come to think, okay, well, I now need to use that 24,000, you won't be able to do as much with it. So really investing you are massively losing out, possibly almost up to double your money, and that's no guarantees. It is volatile. It does change each year. But it does mean that you would have less bang for your buck, so to speak, when it comes to what you would need in the future. So there's a real cost of losing out between £15,000 to £30,000 over that long-term period. And so when you've got that sort of significant margin of difference over time, and you're getting the more you can put in, and that's what happens with pensions. So the more you put into your pension, either through work or personally, or you do through investments outside of your pensions, the more resources and more choice you'll have later on. It's just deciding now, how do you want to divvy up your income that's coming in each month, to decide, okay, am I going to put 5% aside for the future? Am I going to put 10% of my earnings each month for the future? Can I afford to do more than that? And you can include your pension within that if you're making pension contributions through work already, or you can say, okay, I'll keep that separate and I want to increase that to that next point. Now, for a lot of people, it comes back to planning. It's okay, asking the question, what do I need to put in? And normally, if you're late in the day, that amount can be quite high. So I'd encourage people to start with somewhere and just increase what you're already putting in. And if you can try and increase what you're at least by inflation. So if you use 4% as a general benchmark, although inflation is slightly less than that at the moment, if you use that as a benchmark, whatever you're paying in now, each year try and increase it by 4%. That also can have a massive impact because then you're beating inflation. So that increase that's maybe 3 or 4% each year where things naturally go up in cost, if you're then increasing your monthly payment, so it becomes becomes £104 rather than just £100, that means you're beating inflation and therefore your returns are that much more impactful over the long term because you're technically putting in more. So then therefore that value is more valued more in the future. And if you did that the following year and the following year, so one small baby step that you can do today is just by whatever you're currently doing, increase it by 4 or 5%. And that will mean that you're increasing that with inflation in line with the way that things are going up in cost. So what matters more than the amount, although as I've mentioned, the amount does matter, is the driven growth is time. So it's not about timing the market, as there's a saying that goes around in investing. It's not timing the market. I'm going to buy now and sell here. It's about the longevity of time in the market. Now, there was always a bad time. It's happened for a couple of clients at COVID, but that was also to their benefit. There's some other clients it was to their benefit because once the market dropped, that was a good time to invest. But actually, what it's more about is those regular, monthly, continuous and consistent investments that has the biggest and the most impactful change. So, and what could that mean in real life? It could mean that you retire earlier. You could maybe start working part-time rather than full-time for longer. It might be that you then can help out financially to your children or grandchildren. And it will mean that when you come to that time, you'll feel less stressed about what that future looks like because we are living longer. We're not actually living shorter. Medical prevention means that we are living longer. And if you don't, then it might mean that you actually have to work it later into your 70s to pay for the cost of living. And you'll feel like you're constantly catching up with that sort of feeling of living from hand to mouth. So looking back at how you're currently spending and what increases you can make now is really important. And I'd say that's the first thing, just by going through all your expenditure, review your insurances that you're paying for, the car insurance, the dog, cat insurance, whatever it might be, and give yourself the time and the accountability, maybe with a buddy of some kind, to review what you are paying for, to adjust and look at, okay, how can I shift 10% or 5% into investing? And it's never too late. You can start today. So even if you're feeling okay, there's no point, I'm 55 or I'm 60 or I'm 65, even just the small amount starting today can have a big impact on that future. Thanks for listening. Thank you for joining us today at Accelerating Your Wealth with your host, myself, Rebecca Robertson. I hope you enjoyed the show. Do subscribe and let us know in the comments any of your thoughts.